Day trading. Most beginners lose in year 1. Here's the math, the capital, and the 90-day plan.
70 to 97% of retail day traders lose money in their first 12 months. Under 1% are reliably profitable over 5 years. That's not a YouTuber making noise. That's the consensus across the SEC, FINRA, ESMA, and academic studies in 3 different countries. 3 studies in particular: Brazil, Chague and De-Losso tracked traders through 300-plus sessions, 97% lost. Taiwan, Barber, Liu and Odean, 5-year sample, fewer than 1% reliably profitable. Europe, ESMA's own disclosure data, 74 to 89% of retail CFD accounts losing. That's the line printed on every CFD broker's banner. They're forced to display it. So why is losing the default? Because day trading isn't a side hustle, it's a zero-sum game against people with faster execution, better data, and lower costs than you. Every tick you give up to spread, commission, or slippage compounds across hundreds of trades a month. Most beginners aren't losing because their setups are bad, they're losing because the math of trading costs against a thin edge eats their account alive. But here's the good news. The number that separates the survivors from the 97% isn't talent, it's $25,000. Hold on to that. If you're in the US trading a margin account, that $25,000 isn't a suggestion, it's a rule that shapes your entire life as a trader. It's called the pattern day trader rule. Here's the mechanic. A day trade is any open and close on the same day. Make 4 of those in a rolling 5 business days and your broker flags you as a PDT. Once flagged, you have to maintain $25,000 of equity at the end of every trading day. Drop below, no day trades until you top up. Violate it, 90-day day trading restriction. The broker enforces this automatically. There are workarounds, but each has a cost. A cash account dodges PDT, but settlement is T+2, so you can't reuse cash for 2 business days after selling. That caps your trade frequency hard. Futures dodge PDT entirely because they're CFTC regulated, not FINRA. Micro contracts on the S&P or NASDAQ let you trade serious markets with $2,000 to $5,000. Or trade outside the US, where leverage caps replace the equity threshold. ESMA, for example, caps retail Forex at 30 to 1. But the real reason that line exists isn't bureaucratic. Regulators said it after the dot-com bust because undercapitalized day traders were getting destroyed. Don't read it as a barrier, read it as a signal, the minimum capital where the activity becomes plausibly viable. Now the most important number in day trading. It's not your win rate, it's your risk per trade. Credible practitioners cap it at 0.5% to 1% of account equity. That's it. On a $30,000 account at 1%, your maximum loss per trade is $300. Sounds tiny. That's the point. Here's why. Even at a 50% win rate with 1.5 to 1 reward to risk, a respectable system, a 5-trade losing streak is statistically routine. At 1% risk, that's a 5% drawdown. At 5% risk, the same losing streak costs you 25% of your account. Same skill, same setups, completely different math. And a bad month for a profitable trader is still a 10 to 15% drawdown. On $30,000, that's $4,500 down. Not because you did anything wrong, but because variance is real. If your reaction to that number is panic, your position size is too large. This is the discipline that separates the 1% from the 97. Not better setups, not better indicators. Sizing so that your worst week never threatens your account. So what do you actually need before going live? 6 things, in order. A regulated broker for your jurisdiction, a written strategy with measurable rules, a paper trading platform, a trade journal, EdgeWonk, TraderView, or even a spreadsheet, a study schedule of at least 1 hour a day for 3 months, and a budget you can afford to lose entirely. That's it. You don't need a $5,000 course. You don't need a proprietary indicator. You don't need a $300 a month chat room. Those are upgrades, never prerequisites. Match the broker to the job. US equities need fast execution, level 2 data, and hotkeys. Interactive brokers, TradeStation, Schwab, Thinkorswim, Webull. Options need low per contract fees and a clean Greeks display. Tasty Trade, Thinkorswim, IBKR. Futures need micro-contract support and low margin. NinjaTrader, TradeStation, Tradeovate. Forex and CFDs need Tier 1 regulation and tight raw spreads. Pepperstone, IG, Oanda, Saxo. Crypto, stick to regulated exchanges with deep liquidity. Coinbase, Kraken, Bitstamp. One hard rule: do not use an unregulated offshore venue for CFDs because the leverage is higher. That leverage is exactly what wipes accounts. Recovering funds in a dispute is substantially harder. Tier 1 only. One note for UK viewers. HMRC can treat highly active intraday trading inside an ISA as outside the wrapper's intended scope. If your activity looks like a business, the safer home is a general investment account. Talk to a tax advisor before scaling. Now the path. 2 hours a day, 90 days, single asset class. Don't try to learn equities, options, and futures simultaneously. Pick one. Weeks 1 and 2. Foundations. Read the SEC's Day Trading, Your Dollar's at Risk. Read FINRA's PDT documentation. Add Andrew Aziz on the mechanics, Brett Steenbarger on the psychology. That's the reading list. Weeks 3 and 4. Platform fluency. Open a paper account. Place 20 to 30 simulated trades. Learn market, limit, stop limit, and OCO orders cold. Read the platform docs cover to cover. Weeks 5 through 8. One setup. Develop and write down a single setup. Trade it on paper for at least 50 occurrences. Journal every trade. Screenshot, rationale, outcome, lesson. Skip the journal and you have nothing to improve. Weeks 9 and 10. Small live test. If paper is positive, fund a live account with $2,000 to $5,000. Trade the same setup at 0.25% risk per trade. The goal isn't profit. It's to feel the emotional difference between paper money and real money. That difference is enormous. Weeks 11 and 12. Review. Compare live to paper. Almost everyone underperforms live. Separate the strategy losses from the psychology losses. Then decide. And the decision matters more than the trading. Most beginners, after 90 days, do not have an edge. The right answer is to stop, save more capital, and revisit in 6 months. The wrong answer is to deposit more and trade bigger. That's the trap. Which brings us back to that $25,000 from the start. Here's why that number actually matters. Not because regulators are being mean, because below that threshold, the math of fixed costs against minimum position sizes works against you. You can technically day trade microfutures on $3,000, but treat that capital as tuition, not a path to income. Start this if you have at least $25,000 of risk capital you can genuinely afford to lose, 2 hours a day for 90 days, and the temperament to journal every trade and walk away at a 2 to 3% daily loss. Day trading rewards traders who behave like a small business. Defined hours, defined process, defined risk. Walk away if you're using borrowed money, a credit card, or savings you actually need. Walk away if you can't survive a $4,500 drawdown without panicking. Walk away if the appeal is the lifestyle rather than the work, because the work is real and the lifestyle is mostly marketing. Here's the honest framing. A $3,000 education at the cost of $1,500 to $5,000 is one of the cheapest professional educations in any field. Go in expecting tuition rather than income, and you give yourself a real shot at being in the small group that survives. Start small, journal everything, cap your risk. The rest is time.
Day trading is tuition, not income. Start small and cap your risk. Full breakdown linked in the description.